I'm Alan Kenny, Editorial Director with REIT.com, and this is Fundamentally Speaking with Calvin Schnure. Calvin, a lot of concern about the weakness in the overall economy. We got a somewhat disappointing jobs report for September. Can you fill us in on the broader implications of that?
Actually, I'd say this is more than somewhat disappointing. This was a very disappointing report. People had been expecting 200,000 or so gain in payrolls in September. It came in at 142,000, well below consensus. And not only that, the previous 2 months had been revised down. So this is a signal, this is a warning sign about potential weakness in the economy. There are some areas that are explainable. We see a decline in mining jobs. Now, a lot of this is related to low energy prices. We've also seen a drop in manufacturing jobs. This is related to exports of manufactured goods, global trade weakness. But even aside from that, the rest of the economy just does not show a whole lot of vigor, a whole lot of strength. We saw a slight downward move in average hourly earnings. So all in all, this is a very disappointing report.
Calvin, big stories globally, weakness in China, weakness in Europe. Are they pulling down the U.S.?
Well, certainly. That's having an impact on the U.S. Our exports are very weak. I'd be more concerned if I thought that this was passing into the domestic economy. And that's one of their worries about a weak labor report like this. But the bottom line is you shouldn't be fooled by the monthly volatility of these numbers. I wouldn't be too worried by a month or two. Now, this is a very weak number, but there are a lot of other signs showing the economy still has a fair amount of strength. One is jobless claims are still very low. Firms are not laying off workers. That's a fairly reliable indicator of what trends are going to be going forward. But we've also seen the consumer is really holding in there. Consumer sentiment is very strong. Auto sales last month were at about an 18 million annual rate. That is a very strong sales pace. And indeed, if you look at the overall economy, people focus on GDP growth, but if you look at the domestic component, consumer spending, investment spending, excluding net exports, if you look at the private domestic economy, it's growing at a 3.5% rate, 3.25% to 3.5% rate over the past year. Now, that's important for real estate because it's the domestic part of the economy that matters. So overall, the U.S. economy is still very resilient. I don't think that this is indicating a major slowdown that's going to trouble the real estate sector.
Calvin, now the big question, interest rates. Does this make it more or less likely that the Fed will raise rates later this year?
Well, certainly this takes a lot of the pressure off the Fed for a near-term move. The Fed has identified two things: improvement in the labor market and achieving the long-term price target, inflation target, before they raise interest rates. Now, obviously, this is a very weak job report. They're not going to be as convinced that the labor market needs them to move right now. But also with no increase in average hourly earnings, that means that there are no wage pressures. This is probably taking some of the pressure off of the Fed for the next meeting or two. But that's really just a timing question. It's clear that the Fed is going to be raising interest rates before too long. The financial markets have been very attuned to this risk. But the important point for the commercial real estate sector is that REITs and real estate are actually earning quite a bit of money. We're seeing rising occupancy. We're seeing rising rent growth. They're going to stand up quite well, even as the Fed embarks on this interest rate hike that we see coming over the next 6 months. So the Fed is probably a little bit more patient than otherwise. It's inevitable that they raise interest rates, but this is really a normalization. This is not something that's going to derail the recovery.
Thank you very much for your time, Calvin.
My pleasure.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.